Hello and welcome to this new appointment with the Funds People interview. Today we will talk about European equity markets in the COVID-19 crisis. And we invited Ben Ritchie, the head of European equities for Aberdeen Standard Investments. Hi, Ben, and thank you for joining us.
Thank you very much for having me today. So it's a great pleasure to be here.
Let's start with the scenario. After the big fall of the markets in the first quarter, in April and in the last weeks, we had a rally, but uncertainty is still very high. Do you think that the worst has passed? Did the markets touch the bottom? And what is the outlook for the second half of the year?
Well, those are the key questions at the moment, and I would not be telling you the truth if I told you I knew the answer to those questions at the moment. It's easy to say that it's an unprecedented situation, but I think that it is in a lot of ways because we don't really have experience of a virus or a pandemic in modern times and the impact that that's going to have on the economy and on companies. So we're quite used to the economic cycle. We're quite used to the ebb and flow of financial markets. But this is, to some degree, an unquantifiable event that's occurred. I think that all said, when we look at companies and businesses, our approach doesn't really change. So we're always looking to find really fantastic companies, world-class businesses. We're looking to own them for the long term. And part of our approach is to find companies which have got the strong balance sheets, strong business models, good cash flows that can allow them to prosper, not just in good times, but also in tough times. And, we're definitely in tough times right now. So the way I see it is, I think it's still very important to be protecting the downside. Things could get worse. We could have relapses. But I think it's also, looking to find opportunities out there as well. Are there good companies which, if we want things forward 3 to 4 years, may actually be back at something approaching normality, whose share prices have fallen a lot in the last 3 to 4 months. And I think it's a balancing act today because we just don't know what's going to happen, right? So I think it's about getting that balance in the portfolio of defense and resilience, and at the same time looking to position ourselves to take some advantage of oversold companies. And it's about getting that balance right. But we are not taking risk in terms of investing in companies who have really weak financing or who, if things don't get better by the end of the year, will be in big trouble. That's not the kind of risks that we're interested in taking. But if we can see some businesses where they've been heavily impacted, the share price has fallen, but they've got strong balance sheets, and we think looking forward over 3 or 4 years that there's a reasonable chance that things normalize, then those are the kind of risks which we're looking to take. It's also worth saying that things have happened very quickly. So the decline from the 20th of February, and we were talking earlier, Filippo, about when we met in Milan back then, within a week or so of that, we saw the start of the market's decline. Within a month, stocks had fallen 35%. That didn't give a lot of time for us to be able to react to that. But over the past 2 or 3 months, we've been able to do the groundwork, to have those conversations with the companies, put ourselves into a position to be able to think about what does the lay of the land look like and what do the sort of outcomes look like. And that's what we've been up to. And so from here, I feel more confident in making some of those investment decisions because I think we have a better view of the range of outcomes than we did a couple of months ago.
Okay, but yes, things happen very, very fast. But in this new environment, some sectors such as transport and travel suffered deeper losses compared to healthcare or IT. But in this new environment, what are the new trends and new opportunities for you?
We're fortunate in that we have pretty conservative position within the portfolios as a starting point. Quite big positions in healthcare, consumer goods, and so forth. The difference with this situation is that some areas and companies which would traditionally have been considered to be quite resilient have not proven to be so, because when the whole economy is closed down, they literally can't sell their products. So something like, let's say Heineken, where traditionally beer sales would be a pretty resilient in an economic downturn, if suddenly your entire off-trade business, which may also on-trade business, which might be half the business is not available, then that's a problem for you. So those sorts of challenges have come into play. Now, what we're doing, if you think about it at the moment, there have really been sort of 4 sectors that have been hit, or segments that have been hit pretty hard. Sort of travel and leisure and aerospace and defense, oil and gas, and the bank sector. Those have been the sort of 4 segments that have really been given a hard time during this period. And what we're doing is looking in those areas, which we have been substantially underweight coming into this crisis. So that's our aim. And within those sectors, we're looking at companies, within the aerospace and defense segment. It could be companies involved in manufacture of engine components for aircraft. We're looking at businesses that supply commercial ovens to restaurants. Those sort of types of opportunities. And then within our portfolios, we already have investments in something like Amadeus, which sells passenger booking software for the travel and leisure and airline sector, which has been hit very hard. But where we see an industry leader, and we see a business which we think long term will continue to do quite well, but which has fallen by 55-60% from the peak. So those are the kind of areas where we see opportunities, not taking balance sheet risk, but looking for where we see substantial upside in some of these areas.
Your investment team has a bottom-up approach on the European equities, very focused on individual companies. What is the specificity of European equities, and why they could be interesting in comparison to other geographical areas such as the US or Asia? China, for example, seems to be better positioned for the recovery than Europe.
Well, I think the great thing about European equities is that it really is what we call a stock picker's market. So it's very much about the companies rather than the overall market opportunity. So it's very difficult for me to come to you and say, I've got a great selling opportunity here for Europe as a whole, compared to the US or China. But when we look at the individual companies, we see plenty of businesses who are positioned to do extremely well over the medium to long term, and to take advantage of some of these big structural drivers that are out there in the global economy. And it's very much my view that a select group of European companies, hand-picked, our portfolios have 30 or so holdings in them, maybe even less in some portfolios, can outperform a portfolio of companies picked from any other market in the world. It's just that you need to be very selective. And if you think about Europe, we have companies with fantastic brand heritage. Think about the Italian luxury goods sector. You can't just make that up. That's hundreds of years of brand equity that have been built up in that. We've got great positioning in healthcare as well. We've got strong positions in technology. We may not have Silicon Valley in Europe, but we've got lots of nice niche players in that area. And then when we look into areas such as industrials, we see lots of fabulous models leveraging European intellectual property. And even within financials, we see niche and leaders within areas like asset management, stock exchanges, and other financial service providers. And in terms of sort of data processing, we've got companies such as Experian or Relex or Wolters Kluwer within Europe that are very strong, robust businesses. We get much more excited about these long-term trends than we do about the challenges that Europe faces from a local economic level, the various challenges that the ECB has in terms of managing the economy. These are difficult issues for Europe, but we get a lot more excited about these longer term trends and the really exciting potential for the companies within Europe.
Thank you, Ben. Thank you for your time.
Thank you very much. It's been a great pleasure to talk to you, Filippo.
Thank you again, Ben, and goodbye.